Hello and welcome. The purpose of this video is to cover Chapter 2 of our course textbook. To begin, we will begin discussing accounts underlying financial statement. So an account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense. Excuse me. The general ledger is a record of all accounts and their balances. Better noted with an example. Here I have broken out our balance sheet accounts. We have asset accounts, liability accounts, and equity accounts. So accounts are organized by the accounting equation. So every item that you see here is an asset. It falls under the asset accounts. Every item that you see here is a liability. And then here we have all of our equity accounts. So do not worry if you do not understand what these are. Particularly for now, you just have to know that, for example, prepaid accounts are considered assets, supplies are considered an asset, and that accrued liabilities is a liability account. So accounts are organized by the accounting equation. So we use accounts to record transactions that happen in the course of business. So here we have our ledger and chart of accounts to explain this a little bit further. So the ledger is a collection of all accounts and their balances for an accounting system. A company's size and diversity of operations affect the number of accounts needed. So the chart of accounts is a list of all accounts and includes an identifying number for each account. So here we have again broken out our assets, liabilities, and equity. Okay, so now that you know what an account is, what a chart of account is, we can now discuss debits and credits. So we have something called a T account in accounting that helps us stay organized. We use a T account because over the course of business, there are tons and tons of transactions. For example, if you go to Office Depot and you purchase a pen, that is considered a transaction. So just think about how many items need to be purchased or money spent in a business. There are lots and lots of transactions. So we use something called a T account to stay organized. So a T account represents a ledger account and is used to show the effects of transactions. So, for example, let's say this is a cash account. Let's say we're going to have a cash T account. We record transactions either on the left side if they are a debit or on the right side if they are a credit. And so every time we have a transaction that involves cash, we will list it out here in our T account. So let's say you spend cash 10 times. Let's say you have 10 different transactions where you go into a store and you spend money. So cash would go down and cash goes down with a credit. So we would put every single transaction here on this T account. And now this is better noted with an example. So we have something called double entry accounting. That just means that every time there is a transaction, two accounts are affected. So we have assets equals liabilities plus equity, which is our accounting equation. And here we are going to discuss what items increase with or which items have a normal debit or credit balance. Beginning with assets, assets have a normal debit balance. So whenever there is an increase to an asset, you are going to increase it with a debit. For example, let's use cash as an example. Let's say you receive $20. You record cash. You record a debit to cash. You record a debit to cash because cash is an asset account and assets have a normal debit balance. Conversely, if you spend cash and you need to decrease cash, you do so with a credit. Now, there is a very neat acronym that will help you memorize the normal debit and credit balances. That can be found in our Canvas module, so I recommend looking at that worksheet after this slide. It is called the AID worksheet, ADE. Okay, so next we have our liabilities. Liabilities have a normal credit balance. So, excuse me, if you need to increase a liability account, you do so with a credit. If you need to decrease your liability account, you do so with a debit. Moving on to equity, equity has a normal credit balance. So if you need to increase your equity account, you do so with a credit. If you need to decrease your equity account, you do so with a debit. Now here, I recommend taking a close look at your textbook and at that worksheet because equity is made up of a few different accounts, and those different sub-accounts have different balances. For example, here we have the expanded accounting equation. So common stock, dividends, revenues, and expenses all make up equity. Now, as you can see here in the previous slide, we said we increase equity with a credit. That's not always the case, though. We have the expanded accounting equation here, and as you can see, common stock increases with a credit. It has a normal credit balance, but dividends increase with a debit balance. So this is where a lot of students get confused. I really recommend taking some time to read through your course textbook, then read it again and again, go through our worksheets, and use this PowerPoint as a guide. Okay, so here we have a cash T account, and I kind of want to show you what the end result is. So we have an account balance is the difference between the increases and the decreases in an account. Note this T account, we have increases in cash recorded on the left, and we have decreases in cash on the right. We net the two, and that gives us our total balance. So we have $36,100 worth of cash coming in. That is an increase to cash. And we have, excuse me, $31,300 worth of cash going out the door. You net the two, and that gives you the balance of the account. So, what did I just discuss? I just threw a bunch of new items at you. It's a lot of useful, but maybe intimidating information. So, here's a quick summary of what we just discussed. So, journalizing and posting transactions, there are a few steps that we follow. Step one is identify transactions and source documents. Remember, there can be hundreds and thousands of transactions that a company goes through. So it's important to stay very organized. Step two would be to analyze these transactions using the accounting equation. For example, if you go to a restaurant and you spend money on your business card, you need to know that cash goes down and that that is an increase to your expenses, to, in this case, your meals expenses. So step three would be to record the actual journal entry. And finally, step four would be to post the entry to the ledger. So here is how we journalize transactions. A transaction will always affect two accounts. It will have at least one debit and one credit. Your total debits must equal your total credits. Okay, so better noted with an example. In this transaction, this first one that we are going to go over, this entity, this company received investment by owner. It looks like this owner contributed $30,000 to the company in exchange for common stock. So in order to journalize this transaction, we need a few items. First, we need to record the date, and you can see we record that here. Next, we need to know what accounts this transaction affects. So if the company received cash, we know that the cash account is affected. And if common stock was issued, then you know the common stock account is affected. So we take the title of accounts debited and we enter it into the debit column. Cash went up, and you know that cash goes up with a debit. So we record debits first in a journal entry, and then we put the amount in the debit column here. Okay, next we have the common stock. So we take the title of the common stock credited and we enter the amount into the credit column. We do so here. And then we include a transaction explanation, normally just a few words noting what happened. For example, in this second transaction, this company purchased supplies in exchange for cash. And then we put in the transaction explanation, we purchased supplies for cash. Okay, so T accounts are useful for illustrations, but balance column accounts are used in practice. That just means for those of you that might already be working in accounting, you might see things look a little bit differently. So, getting around to posting journal entries. Here we have the journal entry that we just recorded, and like I noted, we would then post the amounts into the general ledger. So here's some illustrations. We identify a debit account in a ledger. We enter the date, the journal page, amount, and balance. We enter the debit account number from the ledger in the PR column of the journal. We identify the credit account in the ledger. We enter the date, journal page, amount, and balance. Next, we enter the credit account number from the ledger in the PR column of the journal. So this is a nice illustration of how things flow into one another. So processing transactions. Double entry accounting is useful in analyzing and processing transactions. Analysis of each transaction follows these 4 steps. So we kind of already touched on this, but first we identify the transactions in the source documents. We analyze the transactions using the accounting equation. We need to know, for example, if cash was involved, you need to know that that affects the cash account, which is an asset account. Step 3 would be to record the journal entry, and step 4 would be to post the entry. So this is better noted with an example. I will note here, I will be covering just 2 examples. However, I believe there are about 16 in this PowerPoint. I will not be covering them all, but please go over all of them on your own time as well. They are very important for your understanding, for your homework, and for your upcoming exam. Okay, so in this transaction, we receive investment by owner. So step 1, identify. Fast Forward receives $30,000 in cash from Chaz Taylor in exchange for common stock. So Fast Forward is the company. Okay, so now we need to analyze this transaction. We know that cash was received, so assets go up by $30,000. And since common stock was issued, common stock goes up for $30,000. You know cash is an asset account, and you know common stock is an equity account. Okay. Step 3 would be to record the actual transaction. This is the journal entry. So we went ahead and recorded the debit here for cash and the credit here for common stock. Notice that 2 accounts are affected and that my total debits equal my total credits here. That is very, very important. In accounting, we must always remain in balance. If you're not in balance, then you know something's wrong. Okay, so step 4 would be to post the transaction to the ledger. So, and we'll go over a few examples in the coming slides into what that actually means. Okay, so here in transaction number 2, we purchase supplies for cash. So step 1 would be to identify the transaction. Fast forward pays $2,500 cash for supplies. Step 2 would be to analyze the transaction. You know that both cash and supplies are asset accounts. So as you can see here, cash went down by $2,500, but supplies went up by $2,500. So we are still in balance. We are just moving amounts in accounts within our accounting equation. So it changes the composition of assets, but not the total. Step 3 would be to record the actual journal entry. You debit supplies because you just received supplies in the transaction. So your supplies account goes up. You have more supplies on hand. You do so with a debit, and we know the amount is $2,500. You record that here. Next, you paid cash for the supplies. So you had a decrease in cash. And you know by now that a decrease in cash is recorded with a credit. So now step 4 would be to post the transaction. So after you have analyzed and posted all of the transactions in this PowerPoint example, you will get something that looks like this. Here we have our general ledger, and as you can see, we have all of the transactions recorded here. So in the first example that we went over, we had a debit to cash for $30,000. You see that here. And you also know that that affected common stock, and that is noted here. So here is a brief summary after all the transactions are recorded and everything is said and done. So the next step would be to add up your total balance for each account. And as you can see, we have already done that here. We have cash has a balance of 4,275. Accounts payable has a balance of 6,200, so on and so forth. Now, this is very important information because we're going to learn how to prepare financial statements from a trial balance. So a trial balance has 3 steps. Step 1 would be to list each account title and its amount from the ledger in the trial balance. So you are essentially just taking your totals and reporting it. Step 2 would be to compute the total of debit balances and the total of credit balances. Step 3 would be to verify or prove that total debits equal total credits. Better noted with an example. So you're going to take everything from that summary that was a few slides ago, and you are going to record that here in a trial balance. You're going to add the account, and you are going to bring over the balance. The trial balance lists all ledger accounts and their balances at a point in time. If the books are in balance, the total debits will equal total credits. Think of the trial balance as a summary, as a way to keep things organized. And it's also a good checkpoint because if you did everything correctly, your total debits on your trial balance should equal your total credits. Now, searching for errors. If the trial balance does not balance, the errors must be found and corrected. Now, here are the steps in order to check your work if your total debits do not equal your credits. Step 1 would be to verify the trial balance columns are correctly added. Step 2, verify account balances are correctly entered from the ledger. Step 3, see if debit or credit accounts are mistakenly placed on the trial balance. Step 4, recompute each account balance in the ledger. Step 5, verify that each journal entry is posted correctly. And step 6, verify that each original journal entry has equal debits and credits. You might have recorded an incorrect account. You're just getting started. This is a lot of new information, so it's very possible that you might confuse accounts at first. Maybe you recorded an incorrect amount. And that's okay as well. The neat thing about accounting is that there is a way to catch all of your errors. Okay, so we finally get to the end stage. The goal is to prepare financial statements for investors, right? So you use a trial balance to record your financial statements, and we will go over these in a little bit of more detail. You have four financial statements that will be covered in this class. The first would be the income statement. The income statement reports revenues less expenses over a period of time. It's also called a profit and loss. It gives you your net income. You have something called the statement of retained earnings that reports changes in equity over the reporting period from net income or loss and from any dividends over a period of time. Your balance sheet, which we already went over in a lot of detail, reports the financial position at a point in time. You report the assets, liabilities, and equity here. And lastly, you have your statement of cash flows that will be covered towards the end of this class. The statement of cash flows lists the cash inflows and outflows for the period. A quick income statement examples. So you list out your total revenues and your total expenses. You record your total revenues here, which is just these adding these two above. You record your total expenses here, and that you subtract the two, and that gives you your net income. So I have included both the income statement and the statement of retained earnings here because they are intertwined. So you have your net income from your income statement that flows through your statement of retained earnings. Your you start off your statement of retained earnings with your beginning retained earnings. You add your net income, which we get from our income statement. And we subtract any dividends, and that gives us our ending retained earnings. Okay, so we use the statement of retained earnings to then prepare our balance sheet. We record all of our assets, our liabilities, along with the totals here. And we use the retained earnings balance that we computed in our statement of retained earnings, and we include that part in the equity section of this balance sheet. So as you can see, everything flows through together. So if you make a mistake on one number, it can affect all of your reports. So it's very important to take it slow, check your work, and do not be afraid to ask questions along the way. I hope this video has helped. Good luck on your homework, and as always, please email me if you have any questions. Good luck.